Moody's cuts its U.S. credit rating outlook to negative from stable. The events that moved Treasury yields this past week, and 3 events that might move Treasury yields this coming week. Hello, members and super savers. I hope you're healthy and well. This is what I'll be covering in today's video because, well, it seems there's never an unexciting week in the Treasury market these days. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Moody cited 2 reasons for cutting its U.S. credit rating outlook to negative from stable. 1. Fiscal deficits that will remain very large, significantly weakening debt affordability. And 2. Continued political polarization within our government, making it more difficult to reach consensus on a sustainable fiscal path forward. It seems Moody's has the same concerns that we do on this channel about our country's fiscal spending pattern going forward and its impact on the treasuries that many of us own in our portfolios. And both of these are topics that we've talked about extensively here at NestEgg. The good news about this is that despite cutting its U.S. credit rating outlook to negative from stable, Moody's reaffirmed our current AAA credit rating, stating that, for the time being, the U.S.'s formidable credit strengths continue to preserve the sovereign's rating. In particular, exceptional economic strength, high institutional and governance strength, and the unique and central roles of the U.S. dollar and Treasury bond market in the global financial system. As a reminder, Moody's is the last of the 3 leading credit rating agencies which still rates our country's debt as AAA. Fitch downgraded the U.S.'s ratings to AA+ from AAA this past August, based on a similar rationale to what Moody's had for cutting its U.S. credit rating outlook to negative. And S&P downgraded the U.S. to AA+ from AAA more than a decade ago in 2011. I guess this negative change in credit rating outlook is a warning shot from Moody's that while our country's current overall AAA credit rating is still intact for the time being, if things do not change, an eventual ratings downgrade by the agency will come at some point in the future, which would raise the cost of issuing U.S. debt even further and most likely also raise the cost of issuing debt by the agencies, municipalities, and companies in this country. This news of Moody's cutting its U.S. credit rating outlook was published shortly after the bond market closed last Friday. So let's see what impact this will have on Treasury yields this coming week, especially in light of what we'll be talking about in the next 2 sections of this video. There were 3 events this week to speak about. The first was the 10-year auction, which came in at a high yield of 4.519%. This one was relatively uneventful were it not for the fact that the 10-year is considered the benchmark rate. This yield was a tad bit higher than market expectations before the auction, but results could have been interpreted either way because while demand was weak, it was less weak than the market had expected given the larger volume, the larger supply of notes being auctioned off. Then came the second event, which was eventful and moved bond yields higher. The 30-year auction came in at a high yield of 4.769%. This was much higher than markets had expected before the auction and basically reinforces what we've talked about extensively in these recent videos on why we think Treasury yields need to go higher. Link below for those of you who haven't seen it yet. Investors are basically demanding higher yields for holding longer dated Treasuries. And then came the third event this week that again was eventful and moved bond yields higher. Fed Governor Powell's opening remarks at a panel on monetary policy challenges in a global economy, an event hosted by the International Monetary Fund. It seems that nearly every time Fed Governor Powell speaks these days, the markets move, and this time was no different. Here are some highlights of what he had to say about inflation and interest rates at that meeting.
The FOMC is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. We are not confident that we've achieved such a stance. If it becomes appropriate to tighten policy further, we will not hesitate to do so.
So, here's where Treasury yields ended this past week, and here's where they ended the week before that. As you can see, the yields on short-dated Treasury bills and the longer-dated 10, 20, and 30-year remained relatively unchanged, with the biggest changes in yield happening in the middle for the 2-year, 3-year, 5-year, and 7-year, which shows that the yields went up for exactly the same maturities where the Treasury plans to increase issuance volumes in this quarter's auctions, as we showed you in this table from a previous video. It seems from these early indicators that supply and demand do work themselves out in the open markets eventually. The Treasury increasing the supply of government debt for the 2-year, 3-year, 5-year, and 7-year rather than the other longer dated maturities. It just means that all else being equal, buyers will push down the prices and therefore push up the yields of those same maturities, which brings us to the 3 events that might move Treasury yields this coming week. This past week was relatively quiet in terms of economic data. Well, that's about to change. Here are the 3 events that could move bond markets in either direction this week. On Tuesday, November 14th, the BLS, the Bureau of Labor Statistics, will be issuing the Consumer Price Index report for October. If you're interested in a quick inflation update and what this means for the next I-bond rate, please do drop a comment below and let us know. It will help us to prioritize the video requests that we've received from many of you. So, will October inflation be higher, lower, or roughly the same as in September? Do drop a comment below on this as well if you have a perspective on this that you want to share with the community. Moving on now. On Wednesday, November 15th, the BLS will be issuing the PPI report for October. PPI stands for the Producer Price Index. Whereas the Consumer Price Index report measures the changes in the price of goods and services paid by consumers, so you and me, the Producer Price Index report measures the changes in prices, inflation basically, at a wholesale level across a wide variety of industry and product categories. And then Friday, November 17th, that's 6 days until Thanksgiving and 7 days until Black Friday. That was just a reminder for folks like me who still haven't ordered their turkey yet. The big event that day is actually that the current continuing resolution ends. If Washington does not come up with a plan before midnight on this day, there will be a government shutdown. And it seems from this poll that we ran a few days earlier that about 1/3 of you are expecting a shutdown. Close to 60% expect the government to extend the continuing resolution, and the rest of you, well, you're the perennial optimists. We'll see soon enough. All right, members and super savers, it's looking like another interesting week ahead in the world of fixed income. As always, I hope you enjoyed this video and learned something new. And if you did, I'd love to invite you to continue to support our channel through membership so that we can keep producing one-of-a-kind, objective, sponsorship-free videos for you and for a super saving community. Come for a chat at our next live member Q&A on November 17th at 5:30 p.m. Eastern Time. And check out our latest member Moody and corporate deep dives. Take a look at this video here to learn more about Diamond NestEgg membership, or visit our channel page or the join link in the video description below. See you again very soon with more brand new wealth building content for your financial journey.